So in the previous session we looked at the Fibonacci ratios that are to be used in the case that we are not expecting an extended fifth wave. That is, if fifth wave is normal, then we look at the Fibonacci extension tool and we use the 0.382, 0.50 and 0.618 ratios. And we determined based on that the minimum target for S&P 500 should be between 2500 to 2700 in the near future. And now I will look at the another perspective, that is, if the fifth wave we are expecting is an extended wave, then what we will do or what we should do. So let's just first establish the fact that what kind of a wave we would be expecting in this scenario of S&P 500 chart. So what I am going to do right now is I will check if this wave 3 is extended or not. And why I am doing that is because we have the guideline of equality, which states that one of the waves between wave 1, 3 and 5 should be an extended wave. So if wave 3 is extended, then we expect wave 1 and 5 to be of equal lengths. Similarly, if wave 1 is extended, then we expect wave 3 and 5 to be of equal length. And similarly, if none of the waves 1 and 3 are extended, then there is a high probability that the fifth wave would be an extended wave. So I will use the guideline of equality to check if the fifth wave in this case would be an extended wave or not. So let's just choose the trend based Fib extension tool. I will measure the length of wave 1 and I will project it from the starting point of wave 3. And as you can see that the 0.618 mark, which is here, has not been crossed by the third wave. And I have already discussed this concept of 1.618 ratio in the guideline of equality part in the previous module, and one of the previous modules I mean, and in that we discussed that if wave 3 does not cross the 0.618 mark, then it is not to be considered as an extended wave. Now that in this case wave 3 is not crossing the 1.618 mark, hence neither wave 1 is extended nor wave 3 is extended, and hence there is a high probability that the fifth wave would be an extended wave. Now based on that the fifth wave would be an extended wave, we have a different Fibonacci ratio that we look at. That is the deduction that we did earlier, that was this 2500 and 2700 level, are for the cases when the fifth wave is a normal wave. But in this case scenario we are having the probability that the fifth wave would be an extended wave. And let's just look at what are the ratios that we use in that kind of a case. So let me just first draw the Fib base extension tool from the starting point of wave 1 till the ending point of wave 3 and project it from the starting point of wave 5 or the ending point of wave 4. And as we look in it, we remember that lately we discussed that this level of 0.382, 0.5 and 0.618 are important levels where we expect the wave 5 to end, but that was the case of normal wave 5. But right now we have established the fact that there is a high probability that wave 5 would be an extended wave because wave 1 and wave 3 are not extended. So in that case we look at the level 1 or ratio 1. That is, in that case there is a high probability that the market can go up till the ratio of 1, and which is coming around 3268 level. I'm not saying that the market will go till that level, but I am just stating that it's a general observation that when the fifth wave is an extended wave, then the ratio that we look for the target of fifth wave is 1 generally. And if it's an extended wave, then it can go even higher and cross the other above ratios of like 1.618 and all. But in general you will find the ratio of 1 as the minimum possible target. So now we know two things clearly, that if fifth wave is normal here, it is not say what a mandatory thing for one of these three to be a extended wave. It's just a guideline that one of these three is generally an extended wave. So if fifth wave is normal, then we can expect a target between these two levels of 2500 and 2700. Let me state that over here also. And then we will expect targets between 2500 to 2700. Whereas if fifth wave is to be an extended wave, then we will expect the target to be something around 3200 levels, 3268 something levels. And we have already established this concept in the last session, and we just discussed this one here. So based on this understanding, if an investor is looking to go long, then the level at which he will start booking profits would be around 2500, and if the wave continues to go on higher and higher, then we can look to see levels of around 3200. And if I look even further, let's say that the wave goes even further, then the next target would be around 1.618 mark, which is actually 4169 right here. That is 4100. Let's say it's just 4100 mark if it just keeps on going. Now we are not here to discuss such things like where it will go up till. When the wave 5 would be in progression, then we have the internal wave count of the fifth wave, which we will use to check where it can go up till. But right now we are just simply predicting based on the fib levels and the guideline of equality, and these are the targets that come out in that. And once again, I would like to clarify here that this is not an investment advice in any manner. I am just simply stating these facts for the purpose of education only. If you are using these for trading or investing, then you shall be doing at your own risk. And that was all for the prediction part of this S&P 500 chart. And here you learned that how you can use the tools or the guidelines and Fibonacci ratios for the prediction of fifth waves. And that is all I wanted to discuss in this session. And in the next session we will look at how the guidelines can be used to determine stop loss or point of invalidation.